Before we start today's show, I just wanted to mention our sponsor, Wealthify. Wealthify is regulated by the FCA and is a multi-award winning online and app-based investment service founded in 2016 and owned by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, and Wealthify offers a number of investment products, including a stocks and shares ISA, a general investment account, and a personal pension. However, Wealthify also offers a junior ISA, which allows parents to save for their child's future through investing. Wealthify also offers ethical junior ISAs and the ability for family and friends to pay directly into its junior ISA account for the child's benefit. In the run-up to Christmas, this could provide a meaningful and eco-friendly alternative to present buying. With investing, your capital is at risk and you could get back less than you put in. For more information, head over to moneytothemasses.com and search Wealthify. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, last week's show was titled "It's Starting to Feel a Lot Like Christmas in Equity Markets," and it was a nod to how equity markets appear to be turning a corner and investor risk appetite increasing. Now, we experienced an incredible 3-day rally last week in equity markets, and many of them pushed back towards new all-time highs, or at least recent highs, and bond yields were muted, and the mood was generally one of risk on, and the catalyst was up for debate. But after such a strong rally, perhaps it's to be expected that some of the steam would be let out of equity markets. Now, broadly, most equity markets fell around 2% at the start of this week, and that was largely because there were major hurdles to overcome in the form of central bank policy decisions on Wednesday and Thursday. So that's today as I'm recording this show. Now, central banks globally announced their latest policy decisions, and most of them were actually today, which was why today was dubbed as Super Thursday. And as is often the case, most attention was directed towards the European Central Bank, so that's the ECB, the US Federal Reserve, and of course our very own Bank of England. Now, in recent months, December's meetings were certainly seen as live meetings for the US Federal Reserve and the Bank of England, and that means there was the expectation for tightening of monetary policy on both sides of the pond. In the case of the Bank of England, then the market had been betting on a modest interest rate rise from 0.1% to 0.25%, and that would make it the first rate rise since the pandemic began. But if you've been watching these shows, then you will know that Omicron muddied the waters and it poses a significant threat to economic growth. Indeed, even some of the more hawkish members of the Bank of England's Monetary Policy Committee, that's the MPC. Now, remember, the MPC is a 9-person strong committee who vote on whether interest rates will go up or down and on QE, and it's a majority vote. And they had, or at least one of the more hawkish people on that committee had gone on record in recent weeks to say that it may be prudent to take a wait-and-see approach with regard to interest rate rises, given the lack of understanding and information really on Omicron and its potential impacts. Now, even the Fed had been deemed to be taking a more dovish tilt in recent months, despite soaring inflation. So there was a lot of uncertainty heading into this week about what key central banks would do, and that meant there was always the potential for them to pull the rug from under investors' feet. Now, the consensus views seem to be veering towards the Fed and the Bank of England being more dovish than had previously been expected. But then by midweek, new data in the US showed inflation had hit 6.8%, which is a 39-year high. And hot on the heels of that data, it was announced that UK inflation had soared to 5.1%, which is a 10-year high. Now, this data obviously piled the pressure on central banks to take action. In the end, both the US and the UK did indeed take action. Firstly, the US Federal Reserve doubled the rate at which it is tapering its QE program, reducing the level of support it provides for the US economy. And while it did not choose to raise interest rates, it did suggest that there would be 3 interest rate rises in 2022. This announcement was made on Wednesday after European equity markets had closed. So it was about 7 o'clock UK time. Now, you may think that markets would have reacted negatively to such a hawkish turn. Indeed, some suggested that Jerome Powell had waited until he secured another term in office before turning the screws on the US economy. But you'd be wrong. In fact, US equity markets exploded to the upside. A hawkish decision was paired with a more dovish press conference from Powell. But equity markets hastily rewrote the investing narrative regardless. Now, the Fed's decision not to rush into interest rate rises was seen as a positive, while the general tightening of monetary policy was seen as a sign that the US economy was on a strong footing. US equity markets exploded higher, with the S&P 500 finishing up 1.63% on the day, while the tech-heavy Nasdaq 100 rallied an amazing 2.35%. Now, it is a perfect lesson in why trying to second-guess what central banks will do and how the market will react is foolhardy. Perhaps the market was just happy that there was no more surprises from the Fed. Now, the euphoria was seen in equity markets globally today, with the FTSE 100 up 1.4%, while European stocks are up broadly around 1 to 1.2%. And this is despite the market being largely caught off guard by the Bank of England, then raising interest rates from 0.1% to 0.25%. But again, the hawkish tone didn't really rattle equity markets. I mean, we did see the pound rally almost 0.5% against the dollar and the euro. I mean, the ECB didn't pull any surprises at all with their meeting, and they've signalled that while there aren't going to be any interest rate rises this year, there probably won't be any next year either. And in the UK, gilts fell in value as investors dumped them in favour of equities. Don't forget that a rising interest rate environment makes bonds less attractive. While we are all concerned about Omicron spoiling the party as we head into the festive season, it would appear that the Fed and the Bank of England are not. Assuming that the market doesn't give up its gains for the last 24 hours, then has Powell given the go-ahead, the green light for the end-of-year Santa rally to get underway? Now, as I pointed out to 80/20 investor members last week, that sometimes it pays to almost keep it simple and forget the ever-changing and contradictory narratives that investment markets conjure up. Now, based on history, there's still a 74% chance of a positive December, so a Santa rally in US equity markets, and an 86% chance of there being one in UK stock markets. Now, it doesn't guarantee that it will happen, but from a numbers point of view, the odds remain favourable even if the market experiences another wobble. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me. Damien at moneytothemasses.com is the email address. Then you can contact me on Twitter, money to the masses with the number 2. Of course, we're doing things on TikTok, Facebook, and don't forget to follow us on Instagram and subscribe to our YouTube channel.